If you've ever dipped your toes into the world of stock investing, you've probably come across the term P/E ratio. Short for price-to-earnings ratio, it's one of the most commonly used metrics in stock valuation. But what does it really tell you about a company? And how can you use it to make more informed investment decisions? In this in-depth guide, we'll explore the definition and basic formula for P/E ratios, different types of P/E ratios, how to interpret P/E ratios in various industries, common pitfalls and misconceptions, alternative valuation metrics to consider alongside P/E, practical examples and best practices. By the time you're finished reading, you'll have a comprehensive understanding of P/E ratios and how they fit into a well-rounded investing strategy. The P/E ratio, or price-to-earnings ratio, is a valuation metric that compares a company's current share price to its earnings per share, often abbreviated as EPS. In its simplest form, it tells you how much investors are willing to pay for each dollar of earnings the company generates. P/E ratio equals price per share, or stock price, divided by earnings per share, or EPS of stock. Price per share is typically the market price at which the stock is trading. Earnings per share, or EPS, is a company's net income divided by the number of outstanding shares. In practical terms, if a company's stock is trading at $100 and it reports $5 in earnings per share over the last 12 months, its P/E ratio is P/E equals $100 stock price divided by $5 earnings per share, which equals a 20 P/E ratio. This implies that investors are paying $20 for every $1 of the company's earnings. Investors often use the P/E ratio as a quick barometer to gauge whether a stock is expensive or cheap. A high P/E might suggest that the market expects significant future growth in earnings, while a low P/E could indicate limited growth expectations or a company that's undervalued. That said, the P/E ratio should never be the only tool you rely on. It's a starting point, a filter that narrows your focus on potential investment candidates. After all, many factors like industry norms, economic cycles, and company-specific news can drastically affect what a normal P/E ratio looks like. Trailing P/E uses the company's historical earnings, typically over the last 12 months, often referred to as TTM, or trailing 12 months. This ratio reflects how much investors are paying for actual, already reported earnings. Trailing P/E uses the company's historical earnings, typically over the last 12 months, often referred to as TTM, or trailing 12 months. This ratio reflects how much investors are paying for actual, already reported earnings. Pros based on real, audited figures. Cons may not reflect future performance if the company's earnings are fluctuating rapidly, for example, high-growth companies or cyclical industries. Forward. P/E uses projections of the company's upcoming earnings, often for the next 12 months. Analysts look at the company's guidance, market conditions, and other factors to estimate what its earnings will be. Now, one of the pros is that it's more relevant for growth stocks, where future earnings could differ dramatically from past results. However, on the flip side, forward earnings are estimates, meaning they are prone to error, especially if unexpected market or company-specific events occur. In some cases, analysts adjust EPS to exclude one-time charges or extraordinary gains, aiming to arrive at a normalized or core earnings figure. This approach attempts to smooth out earnings volatility, offering a clearer picture of a company's recurring profit potential. Pros can provide a more accurate long-term view if a company has one-off events. Cons, the definition of one-time or extraordinary can be subjective. The P/E ratio remains a cornerstone of fundamental analysis, providing a quick snapshot of how a company's stock price stacks up against its earnings. However, it's crucial to understand that context is everything. Industry dynamics, economic cycles, and the broader market environment can all affect what qualifies as a good or bad P/E. Key takeaways: start here, but don't end here. Use P/E as an initial filter, but dig deeper into financial statements, industry outlook, and management quality before making any commitments. Mind the industry averages. Always compare a stock's P/E to sector norms. A high P/E in one sector might actually be average in another. Consider growth prospects. For growth stocks, forward-looking metrics like forward PE and PEG ratios can provide more accurate insights. Look beyond the numbers. At the end of the day, investing is about the bigger picture: how the company makes money, its competitive advantages, and the skill of its leadership team. With this comprehensive understanding of PE ratios and their nuances, you're better equipped to interpret this widely used metric intelligently. Remember, the key to success in investing often lies in combining quantitative analysis like the PE ratio with qualitative research, for example, competitive landscape, product pipeline, to form a 360-degree view of a company's value.